Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Ooh, I'm not sure if I'm the only one that heard that, but that sounded like a wild animal being killed. All right.
That wasn't me in this case, though.
All right. Well, hopefully, whoever it was, I hope somebody's not on the call driving, because that sounded like a call to OnStar.
And by the way, I do have a really good question here that might be teed up as you go through this mathematical calculation. You want to hear it now?
Yeah, go ahead and throw it out there now.
Okay, so Philip says, I cannot tell the difference between the SMA and the EMA, and which one should I use, basically. And my response is, the SMA is going to be less sensitive to recent moves. So
yes.
if what you have is something that moves rather consistently and not dramatically with these incredible swings to the up and the downside, then the simple moving average should suit you just fine. The reason you would switch to an exponential, which has an increased weighting on the most recent moves, is because every time you've used a simple moving average, you're a day late and a dollar short to it. So you need something that's going to move more quickly, more sensitive to those recent moves, because the recent moves are getting more volatile. Going back to the candles, if your green candles are getting taller and your red candles are getting deeper, then you're probably going to want to consider an exponential. But if they all stay kind of consistent in height and you don't get these big swings from day highs and day lows, then I think simple is going to be just fine. I seldom find that I'm using exponential. When I'm looking at something with a lot of volatility, I might click on an exponential moving average. But the simple seems to work just fine for me.
Exactly right. Tell you what, let's put this in a mind picture for you. Let's say that you have a stock that's just kind of moving, or a price chart that's just kind of moving up in a steady fashion. It's in a nice, easy, steady uptrend, okay? Now, you have a 20 simple moving average and a 20 exponential moving average. So they're both 20. Now, as that price moves up gradually, the simple and the exponential will track each other fairly closely. And, by the way, price will be above both of them. Now, let's say that in the middle of that uptrend, all of a sudden the price jumps up dramatically. What you'll see happen is the 20 exponential will peel away from the simple and will follow the price movement more closely. Then eventually the 20 simple will roll up to follow the exponential. So that's when we talk about a faster or a more sensitive indicator, that's what we're referring to. When you see a drastic price move, the exponential will typically respond more quickly. So as Shawn was saying, if you have greater volatility, the exponential can sometimes give you a quicker response in that higher volatility market. So that's a consideration between the two. But I got to be honest with you. While there is some difference, using one versus the other as opposed to not using anything, you're going to do better, as a rule, having one of the tools rather than just ignoring both of them completely. Now, the last thing that we're going to talk about here, and then we're going to take all this and wrap it up as we look at the FX currency pairs, is the Bollinger Band. Now, this would be something that would be considered a useful indicator for a trending or a channeling market. We just talked about moving averages for a trending market. Excuse me, the Bollinger Band would be for a channeling market. I got to correct myself. So moving averages for trends, Bollinger Bands for channels. All right, how does this work? Well, many of you are familiar with this little picture over here. That's the bell curve. It's also alternately known as the normal distribution, but most people know it as the bell curve. Characteristics of this is it's symmetrical. That is, this side looks just like this side. If you draw a line right down the middle, you could split it in half. Now, here's what we do with the Bollinger Bands. This line right down the middle, we're going to draw using a moving average. Now, typically, you can use whatever moving average you want, but many people use the 20-day moving average. I know there's going to be variations to that, so don't, if you use something a little different, that's fine. You can use any moving average you want, but oftentimes we use the 20-day moving average to draw that line in the middle. Then what we do is we draw a line above and a line below. This is called the upper Bollinger Band and the lower Bollinger Band. Now those lines are drawn a certain distance from the moving average, which is in the middle. How far? Well, you can draw that line any distance, but typically what we do is draw it, even though I have 3 here, we draw it 2 standard deviations. Now, I'm going to stop right there because most of you probably, unless you are fresh out of statistics, don't really remember what the standard deviation was all about. So let me just explain it this way. The standard deviation is nothing more than a number that tells us how volatile the price is. So if price increases in volatility, the number for the standard deviation goes higher. As the price gets lower in volatility, the value or the number for the standard deviation gets lower. But any way you slice it, we're going to draw a line that's 2 standard deviations high and 2 standard deviations low. Now, why would we do this? Here's why. Because if we draw those lines on there, we would say, as a rule, that we would expect about 95% of the closing prices should fall within those 2 lines. So the vast majority of the closing prices ought to be inside those lines. Which means that if we have a closing price, if we get a candle and that closing price on that candle is outside, either above the top one or below the lower one, we could say with pretty good confidence that something has changed. And that simple term, something has changed, becomes a trade signal for the trader. Now, Philip asked the question, why do you have 3 standard deviations on the chart? I know it's a little confusing, Philip. The reason for that is because sometimes we go into that explanation in a little bit more detail, and 3 standard deviations, we usually describe 1, 2, and 3 standard deviations. On this chart, if you were to use 3 standard deviations, that would say that about 99+% of your closing prices would be inside those 2 lines. But because we want something that's a little more practical for traders, we're going to use plus or minus 2 standard deviations. So this is just if we were to go into that explanation in a little bit more detail, but we want to keep it at this level. All right, now at this point in time, here's what we're going to do. We're going to go ahead and switch over to the charts, and we're going to take a look at some real examples of these ICE FX currency pairs. And Shawn, I'll tell you what, I will share my desktop, but I'll drive. If you want to start off, you tell me which one you want to begin with. And in fact, if you want, we could start with YUK, which is the yen, because you got a little bit more experience than most with that. So,
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.